A developing situation in the banking sector has left many online earners and digital content creators seeking clarity regarding recent deductions on their foreign earnings. On May 25th, several independent digital professionals reported that a 7.5% tax deducted at source had been applied to their incoming foreign remittances. The automated deductions occurred without prior notification from the respective financial institutions, leading to widespread confusion over whether tax policies for independent online workers have changed. To understand what is driving these deductions, Centrist Nation investigated the banking response and looked into the official provisions of the NBR Income Tax Act of 2023. Our team spoke with officials across several commercial financial institutions, revealing an inconsistent rollout of this tax enforcement. As of now, Centrist Nation has identified 2 commercial banks that have actively implemented the deduction. Bank representatives stated they are acting under specific regulatory instructions to apply source tax on foreign inflows categorized under digital service and revenue sharing. However, the policy is far from uniform. Multiple other commercial banks have confirmed to us that they have not modified their remittance systems. These institutions state they will maintain their current zero deduction policy until they receive clear, explicit operational guidelines from the central bank. This sudden deduction has sparked intense debate and confusion. Independent workers argue that they have a right to be notified before their accounts are touched, especially since they're actively bringing foreign currency into the country's formal banking channels. The root of this disconnect lies in how the NBR Income Tax Act of 2023 categorizes different streams of online income. According to the official gadget, here is what Section 124 actually establishes regarding foreign remittances. The law states that whenever money is sent from abroad into a local account as a fee, a service charge, or a revenue sharing payout, the bank is legally required to cut the tax right at the source. Specifically, the NBR outlines 3 main scenarios where the 7.5% standard tax rate must be applied the moment the money hits your account. First, if the money is for any service that was physically performed or delivered inside Bangladesh. Second, if a Bangladeshi resident is rendering services or completing tasks remotely for a foreign company or a client. And lastly, if the payment is generated by allowing an online platform to be used for advertisements or other miscellaneous commercial purposes, which is exactly where platform monetization like Facebook and YouTube falls. If a transaction fits into these categories, the bank is instructed to automatically deduct that 7.5% upfront. But here is the most crucial part of the law, what we are calling the golden exceptions. The NBR has left a strict shield for certain types of income where the tax rate drops to exactly 0%. The law explicitly dictates that the bank is prohibited from deducting tax if the foreign remittance falls under 2 major categories. First, educational donations. If the money coming from abroad is a formal grant or a direct donation designated for an educational or research institution right here in Bangladesh, it is completely safe from deductions. And second, the 6th schedule protections. The law states that if your money is protected under specific paragraphs of the 6th schedule, Part 1, specifically paragraphs 12, 17, 21, and 33, it cannot be taxed at the source. So what exactly do those paragraphs in the 6th schedule protect? Let's look at the absolute fine print of the paragraph 21 law to see who is legally safe from the 7.5% tax. The law explicitly states that from July 1st, 2024, all the way until June 30, 2027, an entire list of digital businesses are completely tax exempt. This includes AI and blockchain development, robotics process outsourcing, and software as a service, cybersecurity, data analytics, mobile app development, and traditional software engineering, as well as web development, digital animation, graphic design, data entry, call center services, and of course, IT freelancing. But there is a major catch to lock in this tax-free status. The law states that every single penny of your income, business expenditures, and investments must be handled entirely through bank transfer. No cash under the table, everything must be traceable through the banking system. This highlights the core dilemma for the digital community. Why isn't digital content creation clearly categorized? Is it an IT-enabled service or isn't it? Under current NBR regulations, it remains a classic definitional gray area. The tax law does not explicitly segment content creation as a protected IT service. While creators use sophisticated technology, editing suites, and digital pipelines, the NBR tracks the money from the source. They look at the revenue arriving from Meta or Google and view it as automated advertising and commercial revenue sharing, placing it right outside the protected freelance exceptions. And this is precisely why legal experts emphasize that navigating the tax filing process is absolutely mandatory. According to Bangladesh's tax code, every earning individual is required to hold a taxpayer identification number or TIN and file an annual tax return. Crucially, if your annual net income crosses your designated tax-free threshold, you cannot legally pay zero tax, regardless of investments or rebates. But here is where the mechanical reality of that 7.5% deduction comes into play. Think of this source tax not as a final penalty, but as an advance payment to the government. When the fiscal year ends and you submit your annual tax return, you have the right to show your actual net income. You can legally deduct all of your business expenses, camera gear, production costs, high-speed internet, and crew salaries to reveal your actual net profit. Furthermore, you can provide official proof of your exact service category, whether you are operating an e-learning platform, managing IT-relevant websites, or running any of the other protected digital fields. At that time, if you can present concrete proof that your services structurally qualify under the tax-exempt IT or software categories to claim tax-exempt, or that your overall income tax liability is lower than what the bank took, the math shifts in your favor. Every single taka that was over-deducted can be claimed back as a refund or adjusted directly against your actual tax liability. Essentially, the system treats it as an advance holding deposit. The money is withheld by the banks now, but the final calculation is determined by your annual tax filing. This leads us to the fundamental question that has fueled so much anger across the online earning community. If we are actively bringing valuable foreign currency into Bangladesh when the country needs it most, why are we being taxed at all? Isn't all remittance supposed to be tax exempt? To understand this, we have to look at how the government and the central bank draw a very strict legal line between two types of incoming foreign money. The first category is personal remittance. This is the money sent home by Bangladeshi expatriates working abroad to support their families. That money is already earned, taxed, or handled outside our borders, and it enters the country strictly as a personal cash transfer. The government heavily protects this. They even give cash incentives for it, and it is completely 100% tax exempt. The second category is commercial export income, and this is where the rules change. If you are physically sitting inside Bangladesh, utilizing local internet infrastructure, local power, and your own labor to provide services or generate ad revenue from a foreign platform, the NBR does not view that money as a personal family remittance. They categorize it as commercial service income or export revenue earned by a local resident because the actual work or service is being executed right here from within Bangladesh. It falls legally inside the national tax net. So why implement a tax deducted at source instead of just waiting for everyone to pay at the end of the year? The reality is, the National Board of Revenue relies on TDS for several vital economic and regulatory reasons. Some of the key reasons considered, it is the primary tool to prevent tax evasion. Digital and online earnings are notoriously difficult for any government to track globally. By requiring the bank to cut that 7.5% the exact moment the money enters a local account, the state guarantees it collects a baseline level of revenue upfront. Second, it ensures a steady cash flow for the state, and TDS provides a continuous daily stream of revenue to keep the state running. It expands the tax base and forces compliance. Think of that 7.5% deduction as an automated digital trade. Once a bank cuts TDS on your income remittance, that transaction is immediately registered under your national ID or TIN inside the NBR's central digital ecosystem. If an individual tries to avoid filing an annual return, the system flags the mismatch instantly, forcing workers in the informal digital economy to step into the formal tax system. And finally, it responds to intense microeconomic pressure. Global financial agencies like the IMF heavily pressurizes Bangladesh to formalize its banking sector, manage credit metrics, and curb the use of informal channels like hundi. By automating TDS through formal banking structures and tightening monitoring through platforms like the online inward remittance monitoring system, the state is trying to formalize, track, and stabilize every single foreign currency entering the country. So, the question is whether the freelancers of Bangladesh have tax? No. Unless you are a digital content creator who is generating revenue from Google Ads or Marketplace ads or any foreign sponsor ads. Being a digital creator, you can file for this exempt of this tax if you can provide proof that you are providing or generating e-learning or IT-related content for service. But while the legal text clears up the confusion, it exposes a massive operational breakdown. The primary concern across the remittance community is simple. Why did the banks fail to notify anyone before suddenly flipping the switch and executing these deductions? Our investigation into the banking infrastructure and state records reveals that this was not a sudden policy shift. It is a classic case of administrative flagging, technical roadblocks, and institutional friction. By analyzing the legal framework, we have broken down the two concrete regulatory reasons that delayed this enforcement until now. The NBR versus Bangladesh Bank operational disconnect. Under the Foreign Exchange Regulation Act 1947, commercial banks in Bangladesh are legally prohibited from modifying transaction rules based solely on a National Board of Revenue tax code. They operate strictly under the direct mandate of the Foreign Exchange Policy Department of Bangladesh Bank. For Section 124 of the Income Tax Act 2023 to actually function at the counter, the central bank had to issue a corresponding FEPD operational circular to legally authorize commercial banks to slice 7.5% of incoming electronic wares. Aligning the NBR's tax definitions with the central bank's foreign exchange protocols required a multi-year bureaucratic mapping process that left banks with zero framework to enforce the law until the official directive dropped. The unprecedented structural and administrative overhauls in Bangladesh during mid to late 2024 completely paralyzed routine bureaucracy. Following the governance transition, both the NBR and Bangladesh Bank underwent deep institutional resets, shifting all energy toward microeconomic stabilization and the publication of the authentic English text of the Income Tax Act in late 2025. Minor digital ad revenue taxes were buried under higher priority fiscal crisis. There were clearly deeper unstated reasons why banks suddenly dropped these unannounced changes, and whether they will take full effect anytime soon remains a major question. As we look ahead to the 2026-2027 budget, it's clear more changes are on the horizon. Now, the ball is in the government's court to streamline the system and protect real digital growth. Centrist Nation will continue to track this story closely. Stay tuned for updates.